Welcome to another explainer. So, if you're trying to make sense of today's incredibly fast-moving, frankly chaotic global economy, you'd probably assume the answers are locked up in some new artificial intelligence model, right? Or maybe the latest Wall Street quant forecast. But what if the absolute best playbook for navigating the madness of 2024 was actually written, get this, 2,400 years ago?
Okay, let's dive into this. The brilliant author of the ancient Indian treatise known as the Arthashastra, Chanakya, once wrote that a calm disposition is the sole qualifier for power. Now, I know it is super easy to just brush off an ancient philosopher as some dusty historical relic, but if we actually look at his work through a modern analytical lens, Chanakya emerges as an absolute pioneer of data-driven risk management. We're talking structural intelligence and corporate alignment way before their time.
To really get why this ancient framework is so absolutely crucial right now, we've got to look at the battlefield. Currently, our global economy is being fractured by five massive structural forces. We're dealing with the breakdown of the post-World War II multilateral order, the literal weaponization of global trade and finance, the massive AI productivity revolution that's totally reshaping our labor markets, the green energy transition, and finally, this huge demographic split between aging developed economies and young emerging markets. Now, you might be wondering, how on earth does an ancient text apply to artificial intelligence or global trade? Well, obviously our tools have evolved. The ancient war chariots from Chanakya's day, they're today's autonomous vehicles. And physical treasuries full of gold have basically become digital assets on global ledgers. But the underlying structural power dynamics, the actual mechanics of human behavior, those haven't changed one single bit.
So, we're going to use this ancient manual as our organized roadmap for understanding both modern corporate strategy and geopolitics. Today's explainer is going to cover four key areas: the anatomy of trust, surviving toxic alliances, wealth, risk, and resilience, and finally, the architecture of statecraft.
Part 1. The Anatomy of Trust. Chanakya famously warns that blind trust is basically a fast track to self-destruction. In our modern corporate world, having a robust framework to evaluate your strategic partners is quite literally the boundary line between hypergrowth and total catastrophe. So he proposed four strict tests: sacrifice, conduct, character, and actions. Let's really zero in on that first one, sacrifice, or tyaga. In a modern enterprise, this is all about long-term incentive alignment. Think about Satya Nadella when he took over as CEO of Microsoft. He made this deliberate choice to sacrifice their short-term cash cow in Windows licensing for a massive, decade-long bet on open-source ecosystems in Microsoft Azure. That sacrifice, putting the ultimate strategic position above proximate gain, is exactly what turned Azure into a $110 billion annual revenue machine.
And this brilliantly illustrates the second test, conduct, or achara. You see, a company's true cultural baseline is only really exposed when things hit the fan. Take the 2022 macroeconomic downturn. You had companies like Stripe preserving brand trust by offering 14 weeks of severance, healthcare coverage, and career coaching to the people they had to let go. On the flip side, several startups executed overnight layoffs using automated form emails, because honestly, nothing says "we value you" quite like an automated "dear employee" message, right? The downswing is always the ultimate test of conduct.
Part 2. Surviving toxic alliances. But what happens when an organization is actively trying to pull the wool over your eyes? These days, we constantly see companies with what looks like flawless, audited, superficial transparency, but they're actually hiding deeply unhedged liabilities. Chanakya explicitly warned leaders about this using a really striking ancient Sanskrit term, Visha Kumbha. This literally translates to a pot containing potent poison that's masked by a pristine layer of milk at the surface. It's a brilliant 2,400-year-old warning that perfectly describes modern corporate greenwashing, fraudulent business architectures, and predatory market entities.
And there is probably no better modern example of a Vishakumbha than the spectacular collapse of the crypto exchange FTX. Sam Bankman-Fried built this flawless facade of philanthropic signaling and regulatory lobbying. That was the milk on the surface. But underneath all that, commingled customer funds, totally undisclosed leverage, and entirely fraudulent balance sheets. That was the poison. And because investors completely trusted that surface layer, a $32 billion valuation vanished literally overnight.
We saw that exact same dynamic play out in Europe, too, with the Wirecard collapse. This was a German payments giant that kept up a decade-long illusion of hypergrowth and audited financials. The reality, though? Over $2.1 billion in cash that they reported on their balance sheets simply did not exist. The lesson here is absolutely timeless. Whether you're an investor or an operator, you must validate the validators. Never just accept surface-level transparency as structural truth. So the crucial point is, how do you systematically defend your own portfolio or company against these kinds of toxic alliances? You basically build a modern Chanakyan protocol using 4 distinct layers of defense. First, real-time background intelligence on their public conduct. Second, a deep dive analysis of their actual financial incentives. Third, deliberately running adversarial stress testing scenarios. And fourth, focusing strictly on historical pattern recognition across 5 to 10-year horizons, completely tuning out their recent performance in favorable easy conditions.
Part 3. Wealth, Risk, and Resilience.
Once your alliances are locked down, you have to secure your treasury. And Chanakya was just a profoundly pragmatic economist. He drew a really sharp line between dharmic wealth, which is capital created productively and ethically, and adharmic wealth, which is acquired through speculation or deception. He boldly argued that speculatively acquired adharmic wealth almost never survives past a decade without completely destroying whoever holds it. Fast forward to our global economy. From 2008 to 2022, central banks pumped over $25 trillion of liquidity into the system during this massive zero-interest rate experiment. When the dramatic 2022 rate shock finally hit, asset bubbles completely burst across crypto, commercial real estate, and private equity. The zero-rate era kicked off in 2008, and the collapse came exactly 14 years later. Talk about vindicating Chanakya's mathematical precision on speculative wealth.
To build genuine financial resilience, this ancient framework insists on 4 core pillars: preservation of principal, strategic asset allocation, active reinvestment, and, this is key, a mandatory contingency reserve known as apad dana. Just look at Norway's sovereign wealth fund. By rigorously sticking to this highly diversified, heavily regulated model and holding a massive contingency reserve, they've built a $1.7 trillion fund. That fund generates investment returns that actually exceed their entire annual government budget.
Now, what's really interesting about this slide is how ancient wisdom completely dismantles the modern corporate obsession with just-in-time efficiency. For 3 decades, Western corporations tuned their supply chains to run incredibly lean, minimizing inventory and trying to eliminate redundancy. Sure, they maximized short-term profits, but they also baked immense existential fragility right into the system. Chanakya mandated the exact opposite. He argued that strategic redundancy is a structural requirement. It's an absolute necessity, not an inefficiency.
And man, the world learned this the incredibly hard way during the COVID-19 semiconductor crisis. Because manufacturers had practically zero strategic redundancy, chip shortages ended up costing the global auto industry alone an estimated $210 billion in lost production. Industry titans like Ford and Toyota literally had to idle their factories for months. So yeah, Chanakya's just-in-case philosophy, proven absolutely correct all along.
Part 4. The Architecture of Statecraft.
When we zoom out from boardroom strategy to the world stage, this playbook offers a really robust matrix for understanding global conflict, intelligence, and how capital is deployed geopolitically. Chanakya mapped out 4 instruments of statecraft. The very first is SAM, which is basically the architecture of strategic conciliation. It's all about creating dependencies that look completely voluntary but are actually structurally binding. A totally textbook modern example is the 2020 Abraham Accords. By weaving these deep economic and security interdependencies, especially in technology and banking, between Israel and several Arab nations, the architects engineered a structure of peace that's way more durable than any military guarantee. Why? Simply because the economic entanglement became way too valuable for anyone to sacrifice.
Then we have the concept of DAM. This is all about using incentivization as a form of structural control. In today's geopolitics, nations deploy absolutely massive pools of public capital to lure in private investment. They are deliberately creating irresistible structural dependencies that bend global supply chains to fit their political will.
Let's move to and see how this builds into the massive multi-billion-dollar global subsidy war over microchips that's playing out right now. Just look at the numbers pouring in. We've got the US committing $52 billion through the CHIPS Act, the EU with 43 billion euros, India putting up $10 billion, and Japan with over $6 billion. Guys, this isn't just free money being handed out. This is a highly coordinated global deployment of DAM. These nations are literally using capital to make relocating advanced manufacturing economically irresistible, securing their own sovereign supply chains in the process.
All of this brings us to a deeply fascinating realization to wrap up this explainer. From evaluating the true character of our tech leaders, to spotting the hidden poison in fraudulent crypto exchanges, right up to unpacking the geopolitical subsidy wars over silicon chips, the mechanics of power literally have not changed. Which leaves us with a pretty provocative question to ponder. If a 2,400-year-old text maps this perfectly onto today's incredibly volatile global economy, are we truly innovating our human behavior? Or are we just repeating ancient history on a much faster digital chessboard? Thank you so much for learning with us today, and keep questioning the structures around you.